Given the advancements in weight loss treatments, it's understandable that investors are interested in companies like Eli Lilly. In this video, I'm going to share with you what I feel is a fair price to pay for Eli Lilly stock after conducting a discounted cash flow valuation of this interesting healthcare company. So let's dive into the details.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/partkev for the 10 best stocks to buy now.
All right, to make this calculation, I need several metrics and inputs from Eli Lilly and outside analyst estimates, starting with the market cap for Eli Lilly, which stands at $738 billion, the cash and equivalents balance at $3.369 billion, and the total long-term debt at $31.12 billion. I also need Eli Lilly total outstanding shares, which stands at 905 million. I also need Wall Street analyst estimates for Eli Lilly's expected free cash flow over the next several years, starting with the estimate for 2024 at $8.9 billion, rising to $12.2 billion in 2025, jumping to $18.3 billion in 2026, continuing higher to $24.26 billion in 2027, and keeping the party going at $31.12 billion in 2028. So needless to say, the Wall Street analysts that are following Eli Lilly, they expect the company's free cash flow to surge over these next several years. In fact, the increase in free cash flow at a compounded annual growth rate over these next several years are at 37%, a robust rate of increase for a company the size of Eli Lilly that, as you saw, was approaching a market cap of $800 billion already. I also need the company's beta. According to Yahoo Finance, Eli Lilly stock has a beta of 0.43, which is extremely low. It's one of the lowest of any of the companies I've done a discounted cash flow valuation for. So when I see a beta this low, I usually do a scenario analysis measuring the valuations at higher levels of beta closer to 1 so that I get an idea of what the company's intrinsic value will be at different and higher levels of beta. All right, and now that we have all the inputs, we can go ahead and jump into our discounted cash flow valuation of Eli Lilly stock. And this is as of December 20th, 2024. Starting with the 2024 expected cash flow, according to Wall Street analysts, of $8.9 billion. And the forecasts are all the way up to 2028 for $31.12 billion. Those are according to the Wall Street analyst. From 2029 to 2034, I made my own forecast for Eli Lilly's cash flow growth, and the rate of increase I chose to use is 18.45% rate of increase. And I chose that rate of increase because it's half of the 37% rate of increase that Wall Street expects between now and 2028. I expect the company's increasing rate to slow down over the transition period and then to settle down at a longer-term growth rate of 5% starting in 2035. So all of these cash flows from 2024 to 2035 are forecasts. And remember, forecasts are just that. They're forecasts, they're estimates. Nobody knows precisely what numbers will come in the future. We just make our forecast based on the information available. So because these are numbers for the future, we need to discount them. Or in other words, collect them all and bring them back to today and get a value for all of those cash flows. And this is why it's called the discounted cash flow valuation model, because you're taking those expected cash flows in the future, bringing them all back to today and trying to assign a value to all of those cash flows. And you need a discount rate to do that. And the discount rate I'm using is the weighted average cost of capital at 7.12% for Eli Lilly, with a cost of debt of 7.5% and a cost of equity of 7.1%. Eli Lilly is one of the few companies where I might feel the cost of debt might actually be higher than the cost of equity because the company's beta is so low. Nevertheless, the company only has $31 billion of debt compared to a market cap of 738 billion. So I've assigned them a target capital structure of 10% debt and 90% equity. When you combine all those figures, you get the weighted average cost of capital of 7.12%, which is the rate I'm discounting all of these future cash flows back to today. And those present values of those cash flows are $2.4 trillion. $2.4 trillion is the present value of all of the cash flow that Eli Lilly is expected to generate between today and infinity. Now, of course, you might be saying, how can you forecast cash flows out to infinity? There's a lot of risk associated with that. And you would be correct in thinking that. That's why we're using a discount rate. Incorporated in that discount rate is the riskiness, the risk of those cash flows. That's incorporated in that discount rate. Without that, the value of the cash flows would be much higher. In fact, if you look at the terminal value in the time period 2034, this terminal value is worth $4.2 trillion. But I've discounted this back to today, and the value is just $2.1 trillion. So half of that. And part of the discount of that value is the risk. The other part is the time value, just for the fact that all of us would rather have $1 in our pocket today versus $1 in our pocket 10 years from now. That's just the time value of money. And then you got to add on top of that the riskiness. And so that's all incorporated in that weighted average cost of capital. So the value of operations at 2.4 trillion, you add the cash balance of 3 billion, subtract the debt of 31 billion, and you get a value of equity at 2.4 trillion dollars. From that, we divide the number of shares outstanding, which stands at $905 million. And that gives not $905 million, but just 905 million shares outstanding. And that gives us an intrinsic value per share for Eli Lilly stock at $2,635 compared to the current market price of $767. Now, that's a wide difference, right? That suggests the company is incredibly undervalued. But remember I said the beta is really low, and the beta makes a big difference in valuation. So I did a scenario analysis with 3 different betas. The 0.43 beta is the actual beta for the company according to Yahoo Finance. That's the beta right now when you calculate. However, it doesn't need to stay there. It can fluctuate. And when it does, that'll change the valuation. So I did a scenario here. And I changed the beta to 0.75. And it gave me a value of the shares at $1,353. At a beta of 1.25, the shares were valued at $715. And at a beta of 1, the shares are valued at $949. So in all of these scenarios, only a beta of 1.25, which is roughly triple where it is today, would the share price be overvalued. So in 3 out of the 4 scenarios I've evaluated, Eli Lilly shares do appear to be undervalued. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.